she's a senior portfolio manager, which barely describes the experience she has in the ups and downs of the market. Margie, I'm not going to mince words. It's one of the most optimistic notes on this economy and on the need to participate in markets I've seen in weeks. Describe your optimism.
Well, my optimism is really based on the way the Fed operates nowadays. The Fed used to be cyclical. They slammed on the brakes, slowed the economy, then flood the system with cash. The economy would go. And now they're really on this secular easing. No sign at all that we can see that there'll be any tightening on the horizon foreseeable future. And so that says to me we're not going to have what we think of as a normal cycle. We're just going to see a steady growth in the economy. Maybe a little slower from this big COVID bounce back, but good enough to make it a good market for equity investors.
The conundrum in the decades of your success is parsing yield versus dividend growth. Which has the high ground right now?
Well, you definitely have to look at equities for all the uncertainties, simply because on a yield basis, they really are very competitive. Certainly with investment-grade bonds, the average yield of the S&P, for example, is about equal to a 5-year investment-grade corporate bond. That doesn't make any sense if we have any sort of growth.
All right. Well, you said that earlier in an appearance that the Fed has effectively crushed the credit cycle, or at least flattened it with respect to the potential defaults that we'll see. I'm wondering, at a time when you see, for example, spreads in high-yield bonds, the extra yield that investors are asked to earn in order to hold these debt over benchmark rates, when you see it climb to the highest level since March of this year, as we're at right now, does that give you a buy signal based on the fact that the Fed has this market's back, or is it a cautionary signal that perhaps there's more to come?
No, I think that spread really reflects what's going on in the ups and downs of the Treasury market rather than high yield. There's very strong demand for high yield still, and there should be, because you get 3 percentage points more yield, and defaults, excluding energy, is only about 1%. So there's very little not to like in the high yield market, except for the low yields, of course.
Right. Well, there's also an issue here where how do you provide fundamental research and how do you look at specific names at a time when there is such central bank support for the entire market?
Well, I think that market supports the price-earnings ratios. I think that makes basically yield securities bonds rather uncompetitive. And I think actually in the Treasury market, there's a scarcity of issues to buy because the Fed has bought up all the free bonds, about a third of the bonds. And so I think when you look at companies, you have to say who can grow faster than what we think will be pretty modest, 2 or 3% for the next couple of years, and look at those companies that have sustainable earnings growth.
Does that have to mean tech, Margie?
Yes, I think tech has a lot of opportunities. It's still a long-term, high-growing sector. And, of course, you need to be choosy here because we've had PEs of many companies be really blown out because people are very optimistic. But I think as we go into the second half of the year, we're going to see more of a convergence on growth from different sectors. And so we may see the air come out of some of those very high levels and other sectors do a little better.
So do you think that we've already seen peak cyclical trade?
Yes, I do. I think what we're going to see now is, again, I'm looking more for secular growth with less cyclicality than we've ever seen for forever in our careers, because of the Fed action, which is really muting any kind of volatility, which they've always caused.
I mean, this is really an important conversation, Margie. I mean, the optimism you've got has been rare this week. It's been a really strange week. And what it comes down to is you're stretching your x-axis out and out and out. Pushing against you are economists lowering their GDP view. Explain those. You're optimistic out, and they're coming down, down.
Well, that may be true, and I think it's partly because we all kind of think we still live in a cyclical world. But if you don't expect rates on treasuries to go up,
right,
it's very hard to expect a change in price-earnings ratios.
Lisa, I think this is incredibly important and speaks to the bracketed 10-year, which hasn't gone to a Steve Major level. I mean, that's the news of the week. The 10-year's a 123.
That's an amazing factoid and actually true. The fact that the Treasury yield hasn't gone down more in the face of some of the declines that we've seen, particularly in the commodity sector.
And that gives Margaret Patel optimism.
It's fascinating. Well, you have to wonder, what are people seeing that provides the counterpoint to this other downward pressure on global growth, which we've seen, decade after decade? And that really raises an issue, Margie. I mean, is there a sort of potential here for Treasury yields to rise, or are we going to remain in this Goldilocks scenario because of the Fed? As you said, they typically create the volatility. At this particular situation, they're not. They're committed to holding policy as easy as possible through the cycle. Does that mean we are going to stay in this range for Treasury yields? Is that a base assumption for your bullishness?
Yes, and I felt that way actually for years. The Fed's dual mandate, full employment and inflation around 2%, to me are, you can't reconcile the two. And so therefore, how can they begin to tighten when we have, 9 million people unemployed? So they'll never get to the 3% unemployment rate, so therefore I can't see them ever tightening.
I mean, Kayleigh, it's amazing how this destroys the taper worry. I mean, everybody's lathered up on taper.
Are they, though, Tom? Yesterday, I asked this question to our Eddie Vanderbilt over on the M Live blog. Why was anybody surprised? Have we not been having this conversation about a taper coming in the next 3.5 months or so of the year, that it was all too likely that the Fed was going to announce those plans, and yet it seemed to take the market by surprise? And yet I'm not really sure what exactly has changed. I mean, Margie, do you think anything has changed in terms of the taper conversation?
No, it ebbs and flows with market fears. But I think that I don't expect the Fed to taper this year that many people are thinking. And B, even if they do, I don't think that would be bad for the market. They're still going to keep rates very low. And there's actually a scarcity of long-duration Treasury securities for the rest of investors to buy. So the market could actually respond very positively if they say we're going to cut down on our purchases. I don't think it'd be a bad thing at all for the market.
Would it be a bad thing for the market, though, if the Fed ultimately acts too late?
Well, in order to act too late, you'd have to see sustained higher inflation. I think we've already seen signs inflation is tapering down, and we're not seeing a burst of demand in borrowing from business or consumers. So it's pretty hard to see any change from what we have. And so it looks like the Fed may be right on saying they expect inflation to trend down.
Margie, you and I have been doing this for years, and one of the mysteries I have is the elitism of the cash build out in Silicon Valley. Should the tech companies, the big fangs, do they need to dive into the Patel all-dividend pool?
Well, it depends in those cases what their return they're expecting from their own stock versus buying other stocks. But I think it's very common, as you're pointing out, to see companies are awash with cash. They have more cash now than they've probably ever had across the board. And I think they're all still holding it for a rainy day. And so that's good for business. They have the cash reserves if we saw an unexpected slowdown in the economy.
Margaret Patel, thanks for the brief this